Hi everyone, welcome to my channel where experts share their knowledge. For this video, I'm interviewing the economist James Rickards. He has written a book called The New Great Depression, where he gives a dark glimpse of the next years. Let's hear what he has to say. Hi James.
Thank you, Clement. It's great to be with you. Yeah.
In your book, you're casting a dark light of the upcoming decades. But now, with the vaccination starting all over the world, isn't it just a matter of time until we can go back to normal?
Right. The answer is no. There won't be a normal. We will get through it. At some point, the pandemic will be over or contained, and life will go on. But it will not be normal. We're entering a new stage that is the kind of thing that happens with severe crises, whether it's the first Great Depression. My book is called The New Great Depression, but going back to the first Great Depression, 1929, 1940, things were never the same, and that has been true of other crises of this magnitude. So first on the vaccine, yeah, it's great that we have the vaccine. It was almost a miracle that the pharmaceutical companies were able to produce it in as short a time as they did, a number of different companies around the world. About 8 months, so that's great. The creation of the vaccine was miraculous. The delivery of it was quite efficient. In the United States, President Trump picked a three-star general who was a logistical genius, and he actually took over the U.S. Postal Service to deliver the vaccine. A lot of Americans were complaining that they didn't get their Christmas cards on time. Well, that's true because they took over the Postal Service. So they got the vaccine where it needed to be. But the governors and mayors have badly bungled the actual rollout, the administration of the vaccine, particularly in New York. You see Governor Cuomo. New York is actually pouring doses down the toilet because the way the vaccine, some of the vaccines work, they have to be frozen at about 100 degrees below zero. And they can do that, and they get delivered. But then when you're going to administer them, you have to sort of defrost them, get them to room temperature, and then administer them. But when you do that, it's like a quart of milk. It's only good for about 2 days, and then it goes bad. Well, New York was so inefficient at administering the vaccine that the doses started to go bad. So on the one hand, the governor's complaining about a shortage. On the other hand, they're flushing them down the toilet because they can't get them out fast enough. So that's just, good old-fashioned red tape, inefficiency. The same problems exist in France. The only countries that have done a really good job of administering the vaccine are Israel and the UAE. Abu Dhabi and Dubai have done a good job, a few others, but basically it's very inefficient at the point of delivery. Meanwhile, the pandemic itself is spreading faster than the vaccine can be administered. It's spreading faster than it did last spring. Everyone remembers March, April, May of 2020 with the lockdowns and the quarantines and so forth. But today the caseload is about 10 times higher. The fatalities are almost double. In other words, the pandemic is worse than it was last spring, spreading faster than it did last spring. On top of which we have some mutations. It's not clear yet. We don't have enough information as to whether the mutations will succumb to the vaccine or not. But it's not unusual for viruses to mutate, but some mutations are harmless. They don't affect the ability of the virus to spread, but some are extremely harmful. The scientists actually call it mutation escape. You can think of the vaccine as creating antibodies to stop the virus, but the virus doesn't end run around the vaccine, comes up with, as I say, some mutations. So the rollout of the virus is poor. Sorry, the rollout of the vaccine is poor. B, the virus is spreading faster than the vaccine can be administered. And C, the virus has shown some capacity, not unusual, to mutate around the vaccine. So best case, the vaccine may have some beneficial impact late in 2021, early 2022. Worst case is the virus mutates and we get new waves, and the vaccine is a very limited utility in dealing with the new waves. So that's the first problem. But the second problem, which will be true, is true whether the vaccine is highly effective or not, is the behavioral adaptations we're talking about will be intergenerational. And I can give an example of that. I grew up in the 1950s and the 1960s. It was a fairly prosperous time in the United States. I did not live through the Great Depression, but my parents did, and my grandparents did. So I was actually raised with a kind of depression mentality, if you will, even though I didn't live in the depression. We would take the rubber bands off of newspapers delivered in the morning and save them in a jar. We went out as kids, 9-year-olds, with our wagons to collect newspapers in tin cans door to door. Not for environmental reasons. It might have been good for the environment, but we were recycling the tin because you could build ships and planes with it. So that didn't change until the late 1960s when the baby boom came of age, and then, credit cards and mortgages and, the economy, the consumer economy boomed from there. But my point is the effects, the behavioral effects of the Great Depression lasted for 30 years, not, 30 months. Now, there's research that supports that, and I talk about this in my book, The New Great Depression, from the Federal Reserve Bank of San Francisco and several academic collaborators. They looked at every pandemic since the Black Death, every pandemic in the last 650 years in which 100,000 or more people died. And there were 15 of them that they identified. And what they showed, and they're economists, not epidemiologists, but they had the data, the fatality data. Of course, the two worst were the Black Death, about 75 million dead, and the Spanish flu, about 100 million dead. By the way, COVID-19, the current pandemic, will end up, already has ended up as number 3 on the list. This is the 3rd worst pandemic in terms of fatalities in the last 650 years. But what they show with these 15 that I mentioned is that the effects lasted for 30 to 40 years. So when, Jay Powell, the chairman of the Federal Reserve, says, we're not going to raise interest rates till 2023, I say, that's fine, Jay. Why don't you try 2043? Because that's what we're talking about. When a little girl goes to school, I have grandchildren, 5, 6 years old, and the mommy says, honey, put on your coat, put on your hat, and put on your mask. And the kids do. Kids are adaptable. They'll put on their mask. But that's the kind of thing that stays with you your whole life. So the notion that somehow, monetary policy and fiscal policy can cure this, which they won't, I explain that in chapter 4 of my book, is just not true. But as I say, the behavioral effects will last for decades.
What makes you so sure that we are going to see a new depression? Most economists predict strong growth rates for this year. Why do you think this won't happen?
Because most economists are wrong about almost everything. They did not see the dot-com crash coming. They did not see the 2008 financial crisis coming. They did not see the pandemic coming. They did not see the 2020 severe recession coming. They get everything wrong time and time again because they have the wrong models. The Chinese are even easier to analyze. They lie about everything. It's a communist regime, and they just lie. So if you believe the Chinese, good luck to you. But I don't. And once you know they're lying, it's at the beginning of trying to understand what actually is going on there. So economists use flawed models. They use the Phillips curve, which is now flat. At least I was pretty good at geometry. I never remember curves being flat. They're usually curved. So their monetary model is wrong because they don't take account of velocity. Their fiscal model is wrong because they ignore the fact that debt to GDP ratios are now in excess of 90%. The research shows that at that level, your Keynesian multiplier is less than 1, meaning if you borrow $1 and spend $1, you get less than $1 of GDP, which means your debt to GDP ratio goes up. People save more and spend less. So monetary policy will fail because of what's called velocity, or the turnover of money. I mean, just to be specific, the Federal Reserve, our U.S. central bank, has printed almost $4 trillion in the past year. This time last year, the Federal Reserve balance sheet was about $3.6 trillion, give or take. Today, it's about $7.5 trillion. So that's $4 trillion of new money printing. But the money printing doesn't matter. It does not stimulate. They call it stimulus, but it's not. It does not stimulate, and it does not cause inflation. What causes inflation potentially is the turnover of money. The technical word is velocity, but it just means the turnover. So, for example, let's say I go out to dinner and I tip the waitress, and the waitress takes a taxi home, and she tips the taxi driver, and the taxi driver takes the tip money and puts gas in his car. Well, in that example, my dollar created $3 of GDP, the waitress tip, the taxi tip, and the gasoline. So that money has velocity of $3 of goods and services for $1 money supply. But if I stay home and watch TV and don't spend my money, the velocity is 0. There's no turnover. I leave my money in the bank. Now, $7 trillion times 0 is 0. Meaning if you don't have velocity, you don't have an economy. And this is what economists don't understand. It's fairly simple. You don't need integral calculus. You just need a little 5th grade math. But the point being, there are behavioral changes that economists don't understand because they're too busy looking at closed form equations. And the point is, the people around the world, I can speak specifically about the United States, but the same is true in Europe and elsewhere. People have been scared. They're afraid. They've been lied to by their governments, and now the governments are saying, "Hey, we want to reopen the restaurants." People don't want to go out; they're too afraid. So, and this is in the data. Again, I'm giving you the theoretical overview, but you can look at the data. You can look at velocity; it's dropping like a stone. It did a cliff dive in 2020. So my point is, all the money printing does you no good, because the velocity is dropping sharply. The turnover of money is not there, and central banks at this point are impotent. They really have no role. Now over to fiscal policy, deficit spending. The United States has added about $5 trillion to its deficit in the past 12 months, with more on the way. But you have to look at something called the debt to GDP ratio. How much debt do you have divided by the size of your economy? Under the Maastricht Treaty, that is meant to be capped at 60%. Angela Merkel has been very adamant about keeping it at 60%. The research is clear that when you get to 90%, the Keynesian multiplier is less than 1, meaning at lower debt levels, if you borrow $1 and spend $1, you can get maybe $1.20 of GDP. But beyond a 90% ratio, if you borrow $1 and spend $1, you get less than $1 of GDP, maybe 80 cents. The point being, at that level, your debt is going up faster than your GDP, your ratio is getting worse, and you're in a death spiral. So where is the United States? So at the beginning of the Trump administration, that ratio was 106%, well past the 90% danger zone. Today, it's about 130%. It's all happening very quickly because we piled, as I say, $5 trillion of debt on a declining GDP. So you increase the numerator by 5 trillion on a $22 trillion base, and you shrink the denominator by about 1 trillion because of the contraction in 2020. Your ratio is about 130%. So who's in that club, the 130% club? Italy, Greece, and Lebanon. So there's your lunch table. Even France and Spain are in much better shape. They're about 90%, maybe a little bit higher. They have their own problems, but the U.S. is far worse. The point being that you now do not get growth. So money printing doesn't work because of velocity. Deficit spending does not work because of the debt to GDP ratio. And everyday Americans, you don't need a PhD in economics. It's probably a disability, actually. But people have an intuitive sense. They know something's wrong. They know it will have a bad end. There are only 3 ways for this to end. One is default. The other one is inflation, where you basically devalue the debt. And the third is higher taxes. But the U.S. won't default because we can always print the money, and the same thing with the ECB. There won't be a default by the developed economies because they can print the money. But that leaves you with inflation and taxes. They're both bad outcomes. And so people just save more. They just say, I don't know how this is going to end, but I'm going to save more because I know when badly they're going to raise my taxes, they're going to do something. So again, it does not have the stimulative effect. And this is in the data. This is I'm referring to work by Kenneth Rogoff as a professor of economics at Harvard, and Carmen Reinhart, formerly at Harvard, now chief economist of the World Bank. But they published a lot of work on this. So monetary policy is impotent because of velocity. Fiscal policy is impotent because of the debt to GDP ratio. Behavioral adaptations will last for decades. And this is all hard data. And we haven't even mentioned lockdowns, which don't work. The evidence is clear. Lockdowns do not stop the spread of the virus. They do destroy economies. They're very good at that. But if lockdowns work, why are caseloads 10 times higher than they were last spring? Well, the answer is they don't work.
So how are the next years are going to look like? High unemployment and low growth rates?
Yeah, best case, unemployment will remain persistently high. Growth rates will be low. This is why I call it the new Great Depression. The point being, people don't understand what the word depression means because economists have banned the D word, as I call it, from usage. They prefer to ignore that depressions even exist. There is a technical definition of a recession, at least in the United States. It's two consecutive quarters, two or more consecutive quarters of declining GDP, and a few other things. And there's a group that declares recessions when they begin and when they end. Economists like that because it's numeric, it's quantifiable, and you can put it in an equation. And a lot of people say, well, if a recession is 2 quarters of declining GDP and a depression is worse, that must be 10 quarters of declining GDP. But no, that's not the definition of a depression. Depression means depressed growth. You can have growth in a depression, but it's depressed relative to trend and relative to potential. And that's dangerous because, again, your debt to GDP ratio is going up. You're spending, you're borrowing faster than you're growing. And it's not, the growth is not strong enough to cure the unemployment problem, et cetera, or the debt problem. So it's kind of a long-term slow motion stagnation. And that would be the forecast. Now, certainly for this year and next year. And, you know, if you use 2019 as a baseline, the last good year, if you want to think of it that way, the United States, best case, will not get to 2019 levels of output until 2023. And we will not get to 2019 levels of unemployment, low levels of unemployment until 2025. So best case, you're looking at 2 to 3 years or more of exactly what I'm describing, you know, depressed growth, malaise, worsening debt to GDP ratios, et cetera. It could be worse than that. I would say that right now, first quarter of 2021, the U.S. is in a second recession, technical recession. We had a recession in the first half of 2020. We had very good growth in the third quarter off a very low base. I analogize it, you know, you fell into a 50-foot hole and you climbed out 20 feet. Well, nice going, but you're still 30 feet underground. That's the problem with third quarter growth, but there was growth. So if you say that recession's over, we're now in a new recession. And the reason is that the virus is back. It's worse than ever. And they're locking down again. Lockdowns don't work, but they don't work to stop the spread of the virus. That evidence is very clear. But they do destroy economies, so we're destroying our economy again.
And there's nothing we can do about it? You just said that monetary and fiscal policy won't work, so there isn't much left.
Oh, there is one thing. It's right here in my book, the New Great Depression. There is one thing we can do, and I describe it in chapter 6 and in the conclusion.
You mean the gold thing?
Well, the gold thing is it's just a tool, right? I'm not saying gold is the answer to everything, but it's a tool that has been used before and is very effective. And here's what it does. Everything I'm describing has a deflationary bias. So even if growth is a little better, I don't expect it will be, but you know, there's some room for variability. But it all has a deflationary bias because of low velocity, because of technology, because of demographics and other factors. Governments cannot tolerate deflation because they don't know how to tax it, number one. And number two, deflation increases the real value of debt. So everyone says, well, that must be good for the banks because they hold the notes, they hold the debt, and if the real value of debt is going up, isn't that good for the banks? It's good right up until the moment the debtor defaults, and then the entire loss falls on the bank instantaneously. And we're seeing that, for example, in commercial real estate. Tenants, again, I'll speak to the United States, but I've seen data from France, it's the same thing. They're not paying the rent. Tenants are not paying rents, about 80% of them. Some of them many of them have gone out of business and they'll never pay the rent. They're done. The stores are closed up, boarded up. But even tenants with some working capital have called the landlords and said, you have to reduce my rent, or you have to give me 6 months free rent, et cetera. If you can't pay the rent, what happens to the landlord? Well, they're leveraged themselves. They borrow the money. They have mortgages. That's how landlords operate. So if you don't pay the rent to the landlord can't pay the mortgage. And people say, well, doesn't that mean the loss falls on the banks? It might, but banks have very cleverly packaged the mortgages into securities and sold them to to you, right? They're in your retirement account. Just take a look. They're in there, at least in the United States. So the point being, there will be this slow motion commercial real estate ripple default playing out over the next year or so, and that will get worse. So that's the deflationary aspect. How do you can't have that. You can't deal with that. You'll destroy the banking system. Also, governments don't know how to tax it. So you need inflation. So that's the answer. We need a lot more inflation. But the Federal Reserve and other central banks around the world have been trying for 13 years to get inflation, and they failed. There's no inflation. And so how do you actually get inflation? Well, the only way to do it is to raise the dollar price of gold, which has almost nothing to do with gold. It has to do with the devaluation of the dollar. So people look in the 1970s, for example. So 1971, the price of gold was $35 per ounce. In January 1980, the price of gold was $800 per ounce. That's a more than 2,000% increase in the price of gold. So everyone says, oh, gold went up. Not really. I mean, an ounce of gold is an ounce of gold. It doesn't change. Its atomic number 79. It's an element, sits in your drawer. It doesn't do anything. But what really happened was the dollar was devalued by 80%. That's what really happened. In other words, it took 2,000% more dollars to buy an ounce of gold at the end of 10 years. So what they did, no one talked about it this way, but what they did is they devalued the dollar by more than 80%, measured by weight of gold. That's inflation. From 1977 to 1981, the U.S. had 50% inflation, 50. Well, that's a problem in and of itself. It hurts people on fixed incomes. It hurts a lot of people, but it makes the debt go away really fast. And so that's what we need. But the central banks have forgotten how to do it. They think you can print money and get inflation, but that Milton Friedman was wrong. The monetarists are wrong. The neo-Keynesians are wrong. They think that printing money creates inflation, and it doesn't. Inflation is caused by velocity, which is psychological and behavioral. So you actually have to change behavior. You have to change inflationary expectations. And the easiest way to do that, in fact, perhaps the only way to do it today, is to increase the dollar price of gold, not to reward gold investors. It would, but that's not the point. The point is it makes the price of everything else go up. This is what FDR did, Franklin Delano Roosevelt did in 1933. The point of taking gold to $10,000 or $15,000 an ounce, which I expect, is to get the price of oil to $400 a barrel, silver $100 an ounce, wheat $20 a bushel, et cetera. Get the price of everything else to go up. There's your inflation. The inflation melts the debt away. The nominal amount of the debt is the same, but the real value is cut in half. And then people will start spending money like crazy because they want to get out of dollars. So it's worked before. We know how to do it. That's the answer. But central banks are, I like to say they're not uneducated. The central bankers are not uneducated, but they're miseducated. They don't understand what we're talking about.
You predict a gold price of $14,000 until 2025. That's quite a bold statement.
Well, not really, because for two reasons. Number one, that's a smaller percentage increase than we saw in the 1970s, so it has happened before. From 1999 to 2011, gold went up 700%. So these things have happened before. But what people don't understand, and again, integral calculus is fine, but you can do a lot of this good economics with fifth grade math. So if gold, right now it's about $1,830 an ounce, give or take, but let's just use 2,000 for a round number, just for ease. So if gold goes from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. But if it goes from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. The point being, in both cases, it's a $1,000 gain. If you have an ounce of gold, you just made $1,000. But at progressively higher levels, the percentage increase of a fixed dollar amount is a smaller and smaller percentage, which means it starts to look like 1 week's volatility. It doesn't take that long. Now, it may take a while to get from 2,000 to 3,000 to 4,000, but then it goes very quickly from there because each percentage increment is smaller than the one before. I mean, you almost have to do it logarithmically to see what's actually going on. So people say, oh, $15,000, it seems so far away. Well, it won't seem so far away when you're at 10 or 11 or 12. It'll happen very quickly. All the more reason to have some gold today so you can participate in that. None of what it's all very simple. It's all historical. It's all happened before. It's straightforward. But central banks are too wound up in their PhD thesis to really understand it.
Besides holding gold, what is the best investment strategy for the next years?
Yeah, high quality long-term or medium-term government bonds, so German bonds, U.S. Treasuries, et cetera. U.S. Treasuries in particular, because U.S. interest rates are still in positive territory. You know, all these bond bears, you know, Bill Gross, Jeff Gundlach, Dan Iveson at PIMCO, they're all saying, you know, interest rates can't get any lower. Short the bond market. It's the greatest bond market bubble in history, et cetera. And one by one, they're being carried out feet first. They've been consistently wrong about this, and they've lost a lot of money. The reason is they don't understand the difference between nominal rates and real rates. The nominal rate is the one you see on television. You know, it's right now, 10-year Treasury note yield to maturity is about 1.1%. Okay, that's the one you see on CNBC or whatever. But the real rate is actually quite high because you have to subtract inflation. So if nominal rates are 1.1, which they are, and inflation is 1.5, which is about right, the real rate is only about negative 40 basis points. I borrowed money in 1980 at 13% for my first mortgage. My mother cried because her first mortgage was like 2%. But I said, Mom, I'm borrowing at 13%, but at the time inflation was 15%. So my real rate was negative 2, plus taxes, plus the interest was tax deductible, and taxes in New York at the time were 50%. So I got a 50% tax benefit on the mortgage interest. So my real rate after taxes and inflation was negative 8. That's a low rate. But right now, real rates are about negative 0.4. So the nominal rate has to go all the way down to 0 and probably go negative, not because of Fed policy, but because of secondary market trading. If you buy a 10-year note from me and you pay me a premium over face value that's greater than the strip of coupons, your yield to maturity is going to be negative. So it doesn't require a Fed policy rate, a negative short-term overnight rate. It just requires a premium greater than the future value of the coupons. So, and that can happen easily, and it has happened in Germany and elsewhere. So as that happens, there'll be enormous capital gains on 10-year Treasury notes. I also recommend cash. It has no yield, but it has, first of all, it could be your best performing asset in deflation because the real value of cash goes up. And it gives you optionality. You can be the one who sits back and, gold's going up, well, I'll buy some more gold. Or, you know, Jim Rickards is wrong, the economy's fine, well, now I'll buy some more equities. The point is, you have optionality and flexibility, and that's very valuable in an uncertain time. So I would say 10% gold, 30% cash, 20% Treasury notes, and there's room for equities. Have a slice of equities, but people with 80, 90% in the equity market are, I don't know how they sleep at night. So I've got to, hopefully that's all helpful for the listeners on our interview.
James, thank you very much for taking your time.
Thank you very much, Thomas.